Hi, both. Thanks for joining us today on our Business Gurus channel, where we will be discussing key business topics to help students grasp the most important elements of their course in preparation for their exams and future career. Let's get started.
You look at almost any big company, right? And their whole mission seems to be about growth,
hmm
getting bigger, expanding, always pushing. It seems relentless sometimes.
hmm
But, if a company is already doing well, making good money, why not just chill? Why this constant drive to grow, sometimes really aggressively?
Yeah, that's a great question.
We often think it's just about chasing the next dollar, the next billion, but the source material we're looking at today, it suggests something deeper, more about survival, defense, maybe even just leveraging how things are structured.
That's spot on. We need to get past that simple more money is better idea.
Right.
Our goal here, looking at these sources, is to really pull out the strategic thinking behind it all.
Right.
It's about understanding how getting bigger isn't just an outcome, it's a tool, a way to protect the company, fend off competitors, and frankly, stay relevant for the long haul. We're digging into those links between size, staying stable, and finding new opportunities.
Okay, let's unpack this. So, before we jump into all the complex strategy stuff, let's cover the basics. What are those core metrics, the non-negotiables that define growth on, say, a quarterly report?
Right, the immediate goalposts, you've got sales, market share, and profitability. Those are the headline numbers, the quick measures of success.
Okay.
But it's worth thinking about why those three specifically. Increasing sales seems obvious, that's the revenue coming in,
hmm
but boosting market share, that can actually be a more powerful signal competitively.
Explain that a bit more. Why is market share so important? Isn't it just bragging rights?
Well, not really. Market share tells you how strong you are relative to everyone else. It's not just your slice of the pie, but how big your slice is compared to your competitors.
Okay.
So say your market share goes from, I don't know, 10% to 15%. That gives you real clout. Suppliers might start treating you better. You can negotiate better deals, maybe lower your costs for materials.
Ah,
And that bump in market share directly feeds the third metric, profitability, because your costs might go down.
so market share isn't just about looking good, it's about power, bargaining power, cost control. It's defensive as much as offensive. Okay, that connects the three nicely. If you ignore sales or market share, your profits could suffer because you lose that leverage, that efficiency.
Exactly. If a company isn't focused on growing in those areas, it's basically standing still.
Mm.
And in today's economy, standing still means you're effectively falling behind because you can bet your competitors aren't standing still.
Mm.
So yeah, those three metrics are the starting point, the immediate signs of success everyone's watching.
But the real strategic advantage, the thing that growth unlocks that really separates companies,
Mhm.
that seems to be in the structural benefits you get from being bigger. This is where it gets really interesting, like how growth changes efficiency and defense.
Absolutely. It fundamentally changes how the business operates, especially its cost structure. The
Mm.
sources really hammer this point. Growing larger makes a business way more competitive,
Mm.
and not just by being able to offer lower prices, but by being fundamentally more efficient. We're talking about things like uh, leveraging fixed costs and getting real economies of scale.
Okay, walk us through that fixed cost advantage. Spreading fixed costs, it sounds a bit like jargon, but it feels core to why huge companies can often undercut smaller ones.
Okay, think about costs that don't really change much, whether you make one thing or a million things, like the rent on a massive factory or the salary of your head tech person or maybe that big software system you invested millions in. Those costs are fixed.
Right.
Now, if a small company makes, say, 1,000 widgets, each widget has to carry a pretty big chunk of that fixed cost.
But if a bigger, growing company makes a million widgets,
Then that exact same fixed cost gets spread super, super thin across all those units. The cost per widget plummets. And that saving, they can either pass it on to customers as lower prices, making them really competitive, or they can keep it as higher profit. So that ability to spread fixed costs, that's a huge driver for growth because it creates an immediate advantage smaller players just can't match.
that's economies of scale in a nutshell. But, we often focus just on the benefits of getting big. Did the sources talk about the downsides, the risks? Because we've all seen huge companies that are just slow and bureaucratic.
Oh, definitely. So sources are quite balanced on this. They acknowledge that just growing bigger and bigger, if you don't manage it well, can lead to what they call diseconomies of scale.
Diseconomies. Okay.
Yeah, basically the opposite effect. The organization gets too complicated, too many layers of management. Decisions take forever. Different departments don't talk to each other properly. All that bureaucracy starts eating away at the savings you made from being big in the first place.
Right. The overhead kills the efficiency.
Exactly. So the real trick, according to this material, is growing smartly. Scaling up, yes, but also actively fighting off that complexity and inertia that leads to those diseconomies.
That makes a lot of sense. It's about manageable growth, not just growth at all costs. And thinking about long-term survival, it feels like growth is almost the only way to hedge against getting wiped out. If you're not expanding, you don't have much cushion when the market gets rough.
That resilience piece is crucial today. Growth allows a business to spread its bets, diversify, maybe expand into new countries or launch different kinds of products.
Okay.
These are types of growth, right?
Yeah.
And they mean that if one area takes a hit, maybe a recession in one region or one product line fails, the whole company doesn't necessarily go down with it. A bigger footprint helps you survive market changes better.
And presumably being bigger helps you react faster too, more data maybe, so you can tweak products based on what customers want or ramp up production if demand spikes.
Yes, exactly. You can respond to customer needs more effectively. And that ties into innovation as well. A company that stopped growing often can't justify spending huge amounts on R&D, developing the next big thing.
Right, innovation's expensive.
It is. But growth provides the cash flow needed to invest in that innovation, to stay ahead of your rivals. The sources kind of imply that not innovating, just waiting to see what competitors do.
Yeah.
Well, that's often fatal in the long run.
Well, which leads us to the external side of things. Let's shift from internal efficiency to what being big allows you to do outside the company, the kind of influence and access to resources that comes with scale. It's like the difference between playing locally and setting the rules globally.
Yeah, a larger business just has more clout, more influence in the market overall. And that's not just about getting better deals from suppliers.
No.
No, it's about potentially shaping industry standards, having a voice in policy debates, maybe even setting the pace for new technologies. That kind of market influence is a huge strategic asset. You can't just buy, you have to grow into it.
And that size creates a kind of gravity, doesn't it? Especially for attracting people.
Exactly. Larger firms are usually in a much better position to attract top talent. Think about it. The best engineers, the smartest marketers. Where do they want to work? Often they're looking for stability, good pay, and the chance to work on big, impactful projects.
Which big, growing companies can offer.
Right, they can offer all three.
Yeah.
It creates this positive cycle. Growth helps you hire great people, and great people fuel more growth.
That ability to just vacuum up the best talent must be a massive weapon against smaller competitors. But maybe the biggest lever of all, especially for really big expansion, is money, finance. What advantages do big companies have there?
Oh, the advantages are huge. And it's way more than just getting a slightly better interest rate on a loan. Bigger companies have access to a whole different set of finance options.
Like what?
Well, think about the difference between, say, funding a small startup yourself versus raising money as a public limited company, a PLC.
Okay, yeah, PLC was one of those key terms in the sources. What does being a PLC actually unlock financially?
Becoming a PLC lets a company tap directly into the capital markets. They can issue shares to the public or sell bonds. They can even use things like commercial paper, basically short-term IOUs that big trusted companies can issue.
Stuff a smaller firm couldn't really do.
Exactly. These options give them access to potentially vast amounts of funding, often cheaper and more flexible than bank loans. They're seen as less risky by investors, which makes getting that capital easier and cheaper. It fuels those really ambitious growth plans.
That difference in financial firepower really explains why some companies seem to explode in size once they reach a certain point. Now, the sources also talked about how companies achieve this scale, the main ways they grow.
Two primary paths, right? That's right. They talk about internal growth and external growth. Internal growth, sometimes called organic growth, is mostly what we've been discussing. Growing by launching new products, selling more in your existing markets, maybe building new factories. It tends to be steadier, maybe a bit slower, generally lower risk.
Okay, steady growth from within. And external growth, that sounds faster, maybe more dramatic.
It often is. External growth comes from mergers and acquisitions, basically buying other companies or joining forces with rivals. The sources suggest this is key when a company needs to grab market share quickly or get instant access to new technology or enter a new country like right now.
High risk, high reward kind of thing.
Potentially, yes. but it can be essential for staying competitive in really fast-moving industries.
Okay, so we've gone from the basic targets like sales through the efficiency gains of scale, all the way to the huge advantages in attracting money and talent. If you bring all that together, the financial side, the operational efficiency, the talent magnet effect, what's the overarching point? The big picture. The big picture, really, is that growth provides two critical things: stability and opportunity, especially in a business world that's always changing.
Stability and opportunity. Okay.
It's the main way companies build resilience. Stability comes from being efficient, being diversified, being able to weather storms. Opportunity comes from having the money, the people, and the influence to jump on new chances when they appear, new markets, new tech. Growth is both a shield and a sword, in a way.
That's a really clear way to put it. A shield and a sword. So, what does this all mean for businesses and for us watching them?
Well, it means the reasons companies chase growth are layered. Yes, it starts with hitting those financial numbers, sales, market share, profitability. But it quickly becomes about strategy, about survival.
Hmm.
Growth acts like a defense mechanism. It helps secure resources, the best people, cheaper finance, market power that protect the company. You could almost say a business that isn't growing is choosing not to defend itself in the long run.
That's a strong statement. For those of you listening who want to dig into the mechanics behind this, the key concepts that kept coming up in our sources were internal growth versus external growth. Those are the hows of expansion. Then there's the significance of being a PLC, a public limited company, especially for funding. And related to that, how companies use different source of finance options to actually pay for all this growth. These are worth looking into more.
Absolutely. And maybe here's a final thought to leave you with, something to chew on. It touches on that tension between defense and offense, stability and opportunity.
Okay.
If the main point of all this growth is ultimately to become stable, to be resilient, is there ever a point where a company is stable enough? Or does the very act of chasing opportunities, which you need to do to stay relevant, mean that the pursuit of growth just has to be, well, endless? Does seeking opportunity always demand more growth?
That's a good question. Is stable enough even a real concept in business? Something to think about.
Definitely.
Thanks for diving deep with us today. We'll catch you on the next one.
Thanks to both of you for joining us today. You've been listening to the Business Gurus. Let's now hand it over to you. What further questions do you have based on what we've discussed so far? Leave a comment and we'll get back to you right away. If you haven't already, hit that follow for more business tips.